Hello and welcome to Finextra. I'm Emily Horler and I'm here with Neil Jeans of Thomson Reuters. Thank you very much for joining me, Neil.
Thank you for having me.
We've seen fintech drive change in retail banking and payments, and we're starting to see this technology spread to risk management and compliance. So why is there a need for innovation in KYC?
Well, banks and financial institutions continue to be early adopters of technology and automation. There are a number of drivers for that. First and foremost is the reduction in costs. Financial institutions in tough business times and difficult markets are seeking to grow their balance sheet. The way they can do that is either to increase revenue or to reduce costs, and both are being looked at as part of the drive to increase profitability. Additionally to that, there's a big focus on customer experience and the way that customers are being treated and how they get access to the financial services industry. We're seeing quite a sizable change in the adoption of online activity by customers. The society is changing as a whole to be more online savvy and more digitally savvy, and the banks are trying to basically match that demand and match that expectation by their customers. Last but not least is that there are finite compliance resources, and innovation is a way of taking those resources and using them for the real value-add work, but thereby removing some of the lower value-add work through automation and the use of technology.
How are regulators evolving to support innovation?
We're seeing regulators become increasingly willing to engage with the financial services industry and also partners to the financial services industry in relation to innovation. I think there's a growing appreciation, particularly around mature regulators and mature regulation, that the regulations were built in a pre-digital age or developed in a pre-digital age. So therefore, by definition, they do not accommodate or sometimes do not allow the use of digital, online and innovative techniques in the area of KYC. But we're also seeing an increasing willingness of regulators to try and change that. There are significant initiatives around innovation in this space we're seeing at the FCA, at AUSTRAC in Australia, but also at the MAS in Singapore. All have specific innovation agendas which they're willing to partner with the financial services industry with.
So how can financial institutions take advantage of innovation in KYC?
I think it ultimately comes down to change in mindset and change in approach. Financial institutions have always been seeking innovation, and if you look through the history of financial services, they're looking for innovation on a constant basis. However, they need to understand that there's a lot of data within their organisations, there's a lot of data externally, and they need to, as part of the innovation process, to be able to tessellate that data across different requirements that they have to face. For example, KYC data can support compliance with not only FATCA, but also MiFID and MiR and Dodd-Frank. And it's actually using that data together that will allow innovation. It also means that they can get better bang for their buck in terms of the data they have internally, but also the data that's externally. I think from a policy perspective, similar to regulators, they need to think outside the box partially in their policy to ensure that they are really focusing on their policy, focusing on ensuring that it actually facilitates innovation and isn't really rooted in things that are outside or outdated, basically.
Neil, thank you very much for speaking with me.
Thank you.
And thank you for watching.